A sound investment portfolio should contain a diverse mix of assets. Putting money in different kinds of investments, such as stocks, bonds, real estate, and commodities, spreads risk. There's even room for more speculative investments. In the 20th century, it might have been wildcatters drilling for oil and not always finding it. In the 1990s, it might have been internet stocks. Today, it's cryptocurrency, also known as crypto. In considering cryptocurrency versus stocks, investors must balance comfort and risk. Investors in digital currencies have had to live with wild swings in value. The roller coaster ride of stock value can be dizzying, but not quite as wild as crypto's ups and downs. Understanding the strengths and weaknesses of each asset and the role they play in a portfolio is necessary to meet the investor's goals. So in today's video, we're going to discuss the key differences between stocks and cryptocurrency, and then you can decide which option is better suited for you. What is cryptocurrency? Cryptocurrency is a relatively new medium of exchange that gained popularity in the past decade. Crypto cheerleaders think the future of finance is cryptocurrency rather than stocks and conventional forms of currency, while others believe that the unregulated nature of cryptocurrency makes it too risky to support a full-fledged financial system. Cryptocurrencies lack government backing, and how much the market will bear determines their value. It relies on blockchain, a distributed ledger technology that tracks and logs crypto transactions. Blockchain combines cryptography, a decentralized network of computers, and the common agreement of users to track transactions. Data from each transaction is kept in a block that connects to those before and after it in a chain that near tamper-proof cryptography protects. Consensus built into the chain validates the transactions. Some say the real value of cryptocurrency lies in the underlying blockchain technology. A number of businesses have adopted blockchain technology for recording transactions made with conventional currencies as a way to increase trust and prevent fraud and money laundering. With Bitcoin prices reaching more than $60,000 a coin, it might seem more expensive to buy cryptocurrency rather than stock. However, investors can buy fractional shares of Bitcoin for smaller amounts. Other vehicles are cryptocurrency funds that are unregulated. Stocks at a glance. In considering cryptocurrency versus stocks, remember that stock conveys ownership of a piece of a company. A company's founder fully owns the company at its inception. As the company seeks to grow, the founder can sell ownership shares to investors. At some point, the company might want to sell shares to more investors in a public offering. This enables the company to raise more money and for early investors to realize a return on their investment. Even when publicly traded, a company can sell more stock. The issuance of new stock dilutes the value of the current shares, but enables the company to raise money. Common reasons for selling additional stock are to raise capital for expansion, hire employees, increase production capacity, and build facilities. Owners of stock can vote to elect members of the board of directors and on corporate policies presented at annual stockholder meetings. They generally have little say in how a company runs from day to day, but if enough investors team up, they can have an impact on the company's direction. Investors benefit when the value of the stock rises, which can be due to the company's performance. On the other hand, the investment loses value when the stock price drops due to poor corporate performance or economic conditions. Investors also get value from their investment if the company pays dividends. A company might begin paying dividends if its directors feel profits can be shared, or reduce or stop paying dividends if the company needs to invest more money in the business. Cryptocurrency versus stocks, the core differences. Cryptocurrency and stocks are valid investment choices, but they serve different purposes in a portfolio. Stark differences exist in how they are bought and sold, as well as how they serve an investment strategy. Here's a look at key characteristics of crypto and stocks. Ownership. To buy and keep stock, a buyer usually has to open an account at a brokerage such as Charles Schwab, TD Waterhouse, or Fidelity. The brokerage makes trades and holds stock in the buyer's name. Newer firms like Robinhood have streamlined the process, but their offerings aren't as robust. A buyer also has to disclose personal information, such as their social security number and street address. Going through a brokerage provides a level of security. One of the perceived benefits of crypto is its anonymity, so no one needs to know who the crypto buyer is. A crypto owner holds assets in a virtual wallet or on a storage device such as a USB drive. The downside of anonymity is that responsibility for security falls on the owner, who has to keep track of where the crypto is and remember a password of at least 16 characters. Owners have little recourse if hackers clean out their crypto wallets. Exchanges. Stocks are traded on accredited exchanges throughout the world. They offer stock buyers security, stability, and transparency, and are built to handle large trading volumes every day. Exchanges are strictly regulated, although specifics vary from country, providing protection to buyers and sellers. Exchanges for buying and selling cryptocurrency are newer. Dozens, if not scores, of crypto exchanges exist. Two of the largest are Binance and Coinbase. Some exchanges work with third parties to smoothly exchange conventional currencies, such as the US dollar for crypto. Volatility. Sudden and rapid changes in stock values are as old as stock exchanges. A piece of good news can launch a stock higher, just as bad news can send it lower. As the term Black Friday and Black Monday attest, stock markets can plunge in a day. Usually there's an explanation, either economic or technical, such as a program-driven sell-off. Investors might see the value of their portfolio tumble, but total losses are rare. One thing cryptocurrencies have been known for is their volatility. Ethereum, for example, started 2021 at about $730 and rose to $4,080 by the end of May. It dropped to about $1,786 in July, before rising to $4,082 in late October. Regulation. After the stock market crash of 1929 unleashed the Great Depression, the US created the Securities Exchange Commission to devise and enforce investor protections. Companies are required to disclose all information that can have an impact on their stock value. Investors and their financial advisors have a good deal of information on which to base their investment decisions. By contrast, cryptocurrencies remain largely unregulated, which for some reason investors is a mark in crypto favor. Crypto markets have no borders and are beholden to no governments. However, it leaves crypto buyers with no protection if something goes wrong with their investments. Strategic complements. Cryptocurrency and stocks have some similarities as well as major differences. Investment professionals who recognize the strengths and weaknesses of each can use them in the same portfolio for different reasons. Stocks provide stability. They've been the go-to investment to build wealth for individuals and organizations for most of the 20th century and into the 21st century. Cryptocurrency is a riskier investment. It offers the chance for big rewards, but at higher risk. Together, they can help balance reward and risk in an investment portfolio. But in the end, the final decision ends up on you. So what are you going to choose? Tell us in the comments below.